Have you ever wondered about the best way to grow your money? Today we will delve into the world of investment strategies. Investing is essentially about putting your money to work. It's about making strategic decisions that will help your money grow over time. Now, there are several ways to do this, each with its unique benefits and risks. And that's exactly what an investment strategy is all about. Choosing the right mix of options to suit your financial goals and risk tolerance. In this video, we will explore 4 main types of investment options: stocks, mutual funds, exchange-traded funds or ETFs, and bonds. Each of these presents a different route to the same destination: financial growth. By understanding these options, you can make informed decisions and create a balanced investment portfolio. Now buckle up as we dive into our first investment option: stocks. So what exactly are stocks? Let's think of stocks as tiny slices of a company. When you buy a stock, you're purchasing a piece of that company, making you a shareholder. It's like having a piece of a delicious apple pie. But instead of apple filling and a flaky crust, you're getting a slice of a company's earnings and assets. Now, why would you want to buy stocks? Well, stocks can offer several benefits. First, there's potential for profit. If the company you've invested in does well, the value of your stocks can increase. This means you could sell your stocks for more than you bought them for, making a profit. It's like buying an antique at a garage sale and later selling it at a higher price because it's become more valuable. Second, some companies pay dividends to their shareholders. This is a portion of the company's earnings distributed to stockholders. It's like having a tree that drops money instead of leaves. Pretty cool, right? However, like any investment, stocks come with risks. The value of stocks can go down as well as up. If the company doesn't perform well, the value of your stocks could decrease. So you might sell them for less than you bought them for, resulting in a loss. It's a bit like buying a ticket for a cruise ship that ends up sinking. You've still got the ticket, but it's not worth very much anymore. But how do you make money from stocks? Well, there are 2 primary ways. First, you can sell your stocks at a higher price than you bought them for. This is called capital appreciation. Second, you can earn money through dividends, as we mentioned earlier. When it comes to investing in stocks, it's essential to research and understand the company you're investing in. Think of it as getting to know a friend better. The more you know about them, the more you can predict their behavior. Stocks can be a great investment option if you're willing to take on a bit of risk. But if you're looking for something a bit safer, our next investment option might be for you: mutual funds. Now let's move on to mutual funds. But what are they exactly? Picture pooling your money with a group of other investors, each of you contributing a small sum. This pool of funds is then handed over to a professional fund manager who uses their expertise to invest this money into a diversified portfolio of assets. This, in essence, is the concept of a mutual fund. Mutual funds offer a multitude of benefits. Firstly, they provide access to a diversified portfolio. This means your investment is spread across various asset classes and sectors, thereby reducing the risk of losing all your money if one particular sector performs poorly. Secondly, they offer professional management. The fund manager, backed by a team of analysts, handles the research, selection, and management of investments, freeing you from the time-consuming task of tracking the market. However, like all investments, mutual funds also come with risks. The performance of a mutual fund depends on the market conditions and the competence of the fund manager. If the market crashes or if the fund manager makes poor investment decisions, the value of your investment could decrease. So how do you make money from mutual funds? There are primarily 2 ways: capital appreciation and dividends. Capital appreciation occurs when the securities in the fund's portfolio increase in value. When you sell your mutual fund shares for more than you paid for them, you make a profit. On the other hand, some mutual funds pay out dividends, which are a portion of the income earned from the fund's investments. If you're considering investing in mutual funds, here are a few tips. First, understand your risk tolerance and investment goals. Then, research different types of mutual funds and choose one that aligns with your objectives. Lastly, always remember to diversify your portfolio. Mutual funds offer a relatively safe investment option with decent returns, but if you're looking for even more diversity, you might want to consider our next investment option: ETFs. You've probably heard of ETFs, but do you know what they are? Exchange-traded funds, or ETFs, are investment vehicles that combine the best features of mutual funds and stocks. They're like a basket of different investments, similar to mutual funds, but they trade on an exchange like a stock. This means you can buy and sell ETFs throughout the day, just like you would with shares of a company. So, how do you make money from ETFs? There are two primary ways. First, if the value of the investments within the ETF goes up, the price of the ETF shares also goes up. So if you sell your shares for more than you bought them for, you make a profit. The second way is through dividends. Some ETFs contain investments that pay dividends, which are then passed on to you, the investor. Now let's talk about the benefits of ETFs. One of the biggest advantages is diversification. Because ETFs contain a variety of investments, they can help spread out your risk. If one company or sector isn't doing well, it's balanced out by others that are. ETFs also offer transparency, as they disclose their holdings daily. Moreover, they're flexible. You can buy or sell ETFs anytime during trading hours, and there's a wide range of ETFs to choose from, including those that track specific industries, commodities, or regions. But as with any investment, ETFs also come with risks. The value of an ETF can go down, meaning you could lose money. And while diversification can help reduce risk, it doesn't eliminate it. Here are a few tips for investing in ETFs. First, do your research. Understand what's in the ETF and how it fits into your overall investment strategy. Second, keep an eye on fees. While ETFs generally have lower costs than mutual funds, they're not all created equal. Lastly, don't forget to diversify. Consider investing in several different ETFs to spread out your risk even further. ETFs offer a great way to diversify your portfolio. But if you're looking for the safest investment option, our last topic might interest you: bonds. Last but not least, let's talk about bonds. You could think of bonds as loans, but here's the twist. You're the lender, not the borrower. When a company or a government needs money for a project or to pay off debt, they issue bonds. As an investor, when you purchase a bond, what you're really doing is loaning your money to the issuer in exchange for periodic interest payments and the return of the principal amount on a specified maturity date. Now, let's delve into the benefits. For starters, bonds are predictable. They have a fixed interest rate, which means you'll know exactly how much money you'll receive and when. This predictability makes them a popular choice for conservative investors who prefer a steady income stream over the riskier but potentially more lucrative stock market. Moreover, bonds are generally considered safer than stocks. If a company goes belly up, bondholders are paid before stockholders. This doesn't mean they're risk-free though. There's always the risk that the issuer could default on their payments. And then there's interest rate risk. When interest rates rise, bond prices fall. That's because new bonds issued will have higher interest rates, making existing bonds less attractive in comparison. So how can you make money from bonds? Well, there are two ways. First, you earn interest income from the periodic payments. Second, you could sell the bond for more than you paid for it. Remember, bond prices fluctuate with market conditions, so if you bought a bond when interest rates were high and rates subsequently fall, your bond could be worth more. A few tips for investing in bonds. Diversify your bond holdings just like you would with any other investments. Also, consider your time horizon. If you're investing for the long term, you might be able to handle more risk and therefore might consider corporate bonds, which typically offer higher returns than government bonds. Bonds are considered the safest investment option, but they also offer the lowest returns. Now let's summarize what we've learned today. We've covered a lot today, so let's summarize the key points. We started with stocks, the ownership certificates of a company. They're a gamble, but with high risk comes high reward. Then we dove into mutual funds, where your money is pooled with other investors to buy a diverse selection of stocks, bonds, or other assets. We moved on to exchange-traded funds, or ETFs, that track an index, sector, commodity, or asset. They combine the diversification of mutual funds with the flexibility of stocks. Lastly, we touched on bonds, the safest bet in the investment world. They're essentially loans you give to companies or the government in exchange for regular interest payments. Throughout, we emphasize the importance of diversifying your investment portfolio and choosing the right strategy based on your financial goals and risk tolerance. Remember, the best investment strategy is the one that works for you. So take the time to understand your options and make informed decisions. Happy investing!